Carvana just announced that they're laying off 1,500 employees. The stock is down 96% year to date, and I actually think the most likely path is straight to zero or some type of buyout or acquisition or something like that. But I do not look at this as a turnaround opportunity. I do not look at this as a buy the dip opportunity. This is simply my opinion based off my own research that I think this stock is uninvestable. I don't own shares. I'm not going to short shares, but I do want to put this out there because it teaches an important lesson about the types of companies that we might or might not want to invest in. So what's been the problem? Well, they're laying off 1,500 people or 8% of the workforce following a free fall in the company's stock. Carvana's CEO in an email to employees cites economic headwinds, higher financing costs, and delayed car purchasing. Okay, here's the bottom line. This company has spent a ton of money on buying inventory to try to catch up to demand because they didn't have the inventory they needed to meet demand during through COVID and then into all of the supply chain crisis of the last year or 2 years. Now they have overbought. They're going to be stuck with a bunch of cars that they paid too much for that they're not going to be able to sell. And we're now seeing higher interest rates, a weakening economy, and lower demand for cars. They essentially levered up. They took on a lot of debt. They brought in a lot of inventory at exactly the wrong time. And now they're going to be stuck with it. And they're probably going to have to reduce about 50% more of their workforce if they have any hopes of staying in business. So the CEO said the company failed to accurately predict how this would all play out and the impact that it would have on the business. Okay, and let's just jump straight to the numbers, right? We can see the market cap is $830 million. How you get market cap is by multiplying the amount of shares outstanding by the share price. What we need to look at is the market cap compared to the enterprise value. What the enterprise value does is it takes into consideration all of the debt that a company has as well. And when you see a company in the auto industry or in a high capital expense type industry with an enterprise value of $9.7 billion and a market cap of $830 million, huge red flags should come up, and it is immediately a sign that they have an extremely high amount of debt. If we want to look at Tesla, they have a $562 billion market cap and a $576 billion enterprise value. So $10 billion difference there, which is nothing. Okay, and even if we look at Ford has a market cap of $55 billion and an enterprise value of $239 billion, which is high, right? But that's about 5 times higher, 4 to 5 times higher. If you look at Carvana, the enterprise value is more than 10 times higher than the market cap, okay? And so here's the problem, right? They have $827 million in cash, and you can see it has grown since 2019 into 2020, has dropped significantly from Q2 of 2022 to Q3. But the only reason that this cash has grown, it's not because they're a profitable company and they have positive free cash flow. That's not it at all. The way that they've raised cash is by issuing shares. And what we're seeing is just negative net income, negative net income, negative net income. It's not getting any better. Negative net operating cash flow, consistently negative free cash flow per share, right? And so if we look at the fiscal fitness of this company, this is showing it's got negative free cash flow to equity per share, and it's not getting any better. And in fact, it's actually looks to be getting worse. Operating cash flow growth, same deal. These are all negative and don't appear to be getting any better. This is shares outstanding, and you can see from 2019 they had 46 million shares outstanding. Now they've got 105 million shares outstanding because they keep issuing shares to raise money. Okay, sales and revenue have grown, yes, but they've spent a ton of money on marketing and they're not getting more profitable. Net income is actually getting worse. Debt to equity is getting worse. So this being positive is long-term debt to equity. You want to see this going down, and it's not. Margins. So this is how profitable their sales are. They're getting worse and worse and worse. And as they have to lower prices to hopefully get people to buy their cars with higher interest rates and less demand, this is only going to get worse. And you can see the operating margin is just consistently worse than its industry standard, right? They are below industry standard for operating margin, which is normal. They're a growth company, but they're just a growth company in this industry at the exact wrong time that's levered up and has too much inventory that they bought for too much at the wrong time. You know, Carvana is just a stock. I wish all investors well. I hate to see that people are getting laid off, but no matter how low this stock price goes, I will never be interested in buying this stock. Let me know what you think in the comments, and if you have any stocks you want me to look at, let me know in the comments. If you want to support me, like the video, subscribe to the channel. That really helps me grow and helps more people find the channel.